So our position is going to be less sensitive to changes in the price of the stock than if we just had that short option by itself. So with the exception of that directional impact of delta, when we add in that $110 strike, it really neutralizes or significantly minimizes the impact that the Greeks have on this position. So when we add in that extra leg, the Greeks are not entirely taken out of the equation, but it certainly minimizes that impact, which again, as a seller, what we're looking for is prices to fall. We're looking to reduce our risk, and the I don't want to say neutrality. I can't think of the word that I'm trying to think of, but the idea is that lessened impact also reduces our risk. Our option isn't going to be as sensitive to changes in the market as it would be if we just had that single leg. So that is going to wrap things up for us today. Here are a few key takeaways that we talked about. As we know, selling options, our maximum reward is limited to the premium that we collect. When we turn a short option into a spread, we are reducing our profits, right? But we're also reducing our losses. Typically, the reason people do sell spreads is to minimize that risk. And I should say typically, it's probably one of the biggest reasons people sell spreads. So it's going to be a trade-off. We're reducing our potential risk, but we're also reducing our potential profits because we're selling something at $4 and buying something for $2. Now we've got $2 of premium potential versus just selling that option outright for $4. So we're reducing our profits, but we're also reducing our risks. The defined nature of that risk and reward only exists within that spread itself. If we trade out of one of those legs, if we close that short option ahead of time by buying it back, or if it gets closed through assignment, that defined nature is completely out the window and is going to be replaced with whatever that risk reward profile of the remaining option. After hours trading, after hours news releases, et cetera, can have a significant impact when it comes to our short options. So just because the closing bell rings, your risk isn't off the table. Monitor what's going on in the market, and if you need to act accordingly, and more importantly, within the time frame of your brokerage firm's exercise window. Again, this is another conversation that you want to have with your trading firm because these policies directly impact your trading account. And when it comes to spreads, the Greeks kind of flattened that overall impact of the market influences over our trade. May be good for you, may be bad, depending on what you're looking for. But that's what we've got for you today.